from the morning reading. The topic du jour is high yield bonds. Opinions are easy to come by for this market, but we have focused instead on hard data and real money, and we can see that panic has risen. While history is limited, the past two trading sessions have triggered the kind of pessimism that has been matched only one other time in 10 years. There were 632 new 52-week lows on the New York Stock Exchange on Monday, the most since August. That's nearly 20% of all issues that trade on the exchange. Going back to 1962, it has been almost unprecedented to see nearly 20% of issues at a 52-week low when the S&P 500 was close to 5% of a 52-week high. The only dates that were even close were May the 7th of 2004, July the 26th of 2007. Both led to unsettled markets over the next couple of months, for what it's worth. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 9:03 p.m. Central Time, and I'm recording this in preparation for the market day of December the 15th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So yes, I am recording this on Monday night for Tuesday morning's market open. So there'll be a couple pieces of information that I won't have, obviously, and indeed we can go ahead and jump to the morning report. I won't have the overnight action, so you see I've just kind of blacked out that section. In terms of macroeconomic reports for Tuesday, we'll have the CPI and the core CPI, the Empire State Manufacturing. And there'll be also a little bit of housing data that'll come in during the market hours, so kind of be aware of that. In terms of current market conditions, volatility has certainly been up of recent, though it ebbed a little bit today. Short-term VIX down to a 25.78, but still quite elevated. Skew also down a little bit to a 140, but also still very elevated. IV percentiles for the SPX 39, RUT 36, the NASDAQ a 33, and the Dow a 42. No standard deviation moves were put in on any of the indices today. In terms of our current charts, pretty interesting day today, and you could certainly make a case for both sides. For the bears, obviously we went down and we tested that area that I was talking about, and indeed if you look on the futures chart, it came within 3 ticks of this prior low that we talked about early this morning, and being a critical area for the bulls to support, and that they did. You look at the big long wick here. Well, very important area of support that came in and held. So important to note that wick. Also important to note that you have a green body here. It was an up day and quite a reversal. So this is a reversal candle potentially in the kind of setup we have here. I would call this a bit of a bullish harami, a small green body inside a much larger red body. The expectation would be that this would then, in the short term, lead to an up day on Tuesday. Now, that being said, I would imagine it wouldn't be terribly surprising, the kind of volume and distribution and so forth, wasn't terribly enlightening, but bottom line is that's a pretty good little intraday reversal, and we'll take that for what it is. The other piece of this, of course, is that all this is in front of the Fed, and we're likely to get all kinds of choppy, volatile, or perhaps even settle into sideways and choppy and directionless heading into this all-important Wednesday Fed rate decision. So I wouldn't make too much of any of this short of a break. Now, if we get a break of this area tomorrow or Wednesday morning before the Fed announcement, that would certainly be significant. I can't imagine that we're going to come up here and do anything up above 2100 between now and the Fed announcement. And anything, frankly, between here and here really is kind of meaningless in front of the Fed announcement, which will be likely to redirect it, and all these little indicators and chart patterns and candlestick patterns and so forth will be meaningless once that new information enters the marketplace. That will drive the decision going forward. In terms of some of our other markets, let's go ahead and look at the NASDAQ. Very much the same kind of Harami-like pattern. You might argue that not quite a Harami there. And then also very similar pattern on the Dow. Now the Russell, once again, was not playing the same kind of game. It's an outright bearish candle, and not only did it not reverse, and it also just kept going right down. It did reverse off the lows of the day, so that's 1 point for the bulls, but this is still a very, very ugly candle here, and more of a continuation pattern. And to think that this was up here, at 1200 plus, and really it's been all but down practically ever since. We've had 1, 2, 3, 4, 5, 6, 7, 8, 9. 7 out of 9 days have been down, and one of those up days wasn't terribly significant. And in fact, you could have argued that that was a bit of a reversal, and that failed miserably in that case. So that, of course, being that Friday that was so ugly. So the Russell's definitely playing by its own game, and it's an ugly game for the bulls. Let's take a quick look at volatility. Quite a bit of reversal here. Now, we did have an intraday high that was up over 25, but the importance was that the close was significantly lower, but still elevated levels. We talk about the bulls kind of being this 12 to 18 region. It's got a long way to go to get back down to an 18. So far today, a little bit of action that has been put in on the futures market so far on Monday night, and it seems to be down thus far. And let's look at the bonds. And not much action here so far today on the bonds, though. The Monday regular cash session was a big reversal of the prior day session. So so much for the big up move in bonds and the theoretical breakout. It basically reversed all that today and came right back into the prior pattern. That should be enough on that. Let's go ahead into the regular daily report. Still continue to be with phase 5, the break of horizontal and diagonal support. IBD status remains a market in correction. Accumulation distribution score for the S&P is a D-. NASDAQ also a D-, so very, very ugly there. GMI index remains with a sell signal and a 1 out of 6 score. We'll see if that changes tomorrow morning. In terms of decisions point scoreboards, I don't have any changes for that, but you can see the short term all very, very ugly, and we'll see if that changes after Wednesday's action. Intermediate term market posture very bearish with a flat sentiment line, and position sizing opinions remain at 0 and 50%. That intermediate term market posture you see got even worse today with the S&P dropping to a 27. If that drops below a 20, that goes to severely bearish, and any kind of significant down action day could certainly make that happen. Russell's already severely bearish. The Dow and the NASDAQ also with the S&P in the very bearish camp. Hedge warning status remains threshold level 2 plus, and really the only thing that's preventing this from dropping into a full out hedge risk level 3 is that the S&P on the intermediate term market posture is still not below a 20. If we go to level 3, that will be our highest hedge warning risk level. and usually associated with the kinds of conditions that lead to full out bearish corrections. So kind of keep that in mind. Now, of course, the risk level is not a prediction that will have a significant down move, nor an amount prediction for that drop. But it is telling us that the risk conditions are present in the market, that certainly those things could happen. Much higher probabilities for a drop, and for that drop to be even one or two or even more standard deviation moves. These are the kinds of market conditions in which those kinds of incidents take place. In terms of the specific warnings, you can see we still remain a sea of red here. Almost every single possible warning is still in place. Market decline, sharp increase warning. First day passed on a VIX spike. We are still above an 18 on the VIX futures. The daily squeeze did fire on Friday and continued with that firing today. Distribution days are in market in correction. VIX face is increasing. The skew is up over 140, which is about a 12% probability of a 2 standard deviation, represents about a 6-fold increase over normal conditions. In terms of the current week out expected move, the SPX is now looking at somewhere around as large as a 68-point move that is being priced in by the market makers. And look at this, New York Stock Exchange, new highs, new lows, over 1,000 new lows. We mentioned in the reading that there were 632 new 52-week lows on the New York Stock Exchange. There were over 1,000 new 1-month lows put in. So really ugly conditions. Intermarket risk aversion indicator score is still all 5, flagging risk off. Fear and greed index, quite a bit of fear in the market. It's a 29. And as you would expect with those kinds of conditions, all of our special opinions are basically saying that you do not initiate any new positions that are bullish in any of these strategies for novice traders. In terms of sector specific, pretty much a sea of red with the exception of consumer staples. Did have a decent day today, managed to get those lines to pop up into the up area. In terms of asset class analysis percent change, you can see very ugly today, and it's a lot of these sectors that are even more than 2%, and energy down over 3% for the day and down over 6.5% for the 5 trading day session. Even the 1 month, look at this, double digits, down over 12%. So I've heard a number of people who are wanting to start probe and put some positions on here, and the energy complex, the commodity complex, still seems to be breaking down, and it's opening up the potential for significant new lows if these very important, in many cases multi-year, in some cases multi-decade support levels do not hold. We could have another significant leg down. So be very careful if you're one of those value buyers, and look for those value entries. You have to be prepared to wait a very long time to see that reward. Might want to, in terms of a more positive probabilities, look for some sort of pattern to form with a confirmation that at least a temporary bottom has been put in, and then start scaling into your position. And I think that's probably enough for today. And some of the special opportunities here, you can go to these websites if you need more time. I'll talk more about them on another day. As always, we greatly appreciate you subscribing to us on the YouTube channel. It's free, and that gives you a heads up when the content is posted. And then, of course, you can like it. You can also, if you are a Twitterer, you can retweet our tweets as well as our stock twits, and that also is greatly appreciated. We take acknowledgement that you are finding our content is helpful to your trading when we see that kind of activity. Direct email is support@falconglobaltraders.com, and we love to get the comments. Disclaimers as always, hit the pause button if you need more time to review, and then the full disclaimers here at the hyperlink. And we'll see you back here for the next trading session, and good trading.